We now come to the final section of this reading, which is economic indicators. We use economic indicators to assess the current state of the economy and for insights into future economic activity. There are three categories of indicators: leading indicators, coincident indicators, and lagging indicators. Leading indicators have turning points that tend to precede those of the business cycle. If we look at this business cycle, a leading indicator will turn or change direction before the economy changes direction. A classic example of a leading indicator is the S&P 500 index, or an index return in general. Let's say the S&P 500 represents the US stock market, and therefore the US companies in general. As we've seen in the equity segment of the course, stock prices are based on expectations of what will happen in the future. And given that stock prices are based on future expectations, stock prices will peak before the economy will peak, and stock prices will bottom out before the economy bottoms out. Coincident indicators have turning points that tend to coincide with those of the business cycle and are used to indicate the current phase of the business cycle. And lagging indicators have turning points that tend to occur after those of the business cycle. Let us look at some leading indicators. Everything that you see here is from Exhibit 7 in the curriculum, and I would strongly encourage you to read that exhibit. What I'll do here is just talk about some of these indicators and then make a few general remarks. Average weekly hours in manufacturing. This is a leading indicator because businesses will cut overtime before laying off workers in a downturn, and businesses will increase overtime or number of hours before rehiring in a business upturn. Therefore, these measures move up and down before the general economy, and we call them leading indicators, or this is one example of a leading indicator. I've already talked about the S&P 500 being a leading indicator. Money supply, or real M2, and we will discuss this in more detail in the next reading, but there are different measures of money such as M1, M2, etc. One of the measures of money is called M2, and this is also considered a leading indicator. We'll see this in detail in the next reading, but when the monetary authority increases M2, that will generally have a positive short-term impact on the economy, and a reduction in M2 or a tightening of the money supply is going to have a contractionary effect. Interest rate spread between 10-year treasury yields and overnight or short-term borrowing. This is a leading indicator, and you will understand this better once you have seen the fixed income part of the course, but I will describe it very briefly over here. A wide spread, the spread is the difference between long-term yields and short-term yields in this context. So a wide spread means that we have a upward sloping or a steep upward sloping yield curve. X-axis represents different maturities. So over here we have the very short-term maturities, which we will refer to as the overnight borrowing rates. And here we have the longer-term maturities, such as the maturities on 10-year bonds. The y-axis represents the yields. When there is a big difference between the yields on long-term bonds and short-term bonds, that means that we expect interest rates to go up in the future, or the market expects interest rates to go up in the future. And at this stage, you can think simplistically that higher interest rates corresponds to more business activity, more economic activity. So big spread or wide spread indicates higher short-term rates in the future, which tells us that we expect more economic activity or higher levels of economic activity in the future. And similarly, if the spread is negative, then we are expecting a downturn. Now some general remarks. In the United States, the composite of leading indicators is called the Index of Leading Economic Indicators, or LEI. This composite essentially is a composite of all these leading indicators. It is possible that some leading indicators are telling one story and other leading indicators are giving a different indication. So economists and analysts like to sometimes look at an aggregate indicator, which essentially is the aggregation of these various indices. Different countries will have their own aggregates, but you need to recognize that an aggregate essentially averages out what the various indicators are saying. There is also the concept of a diffusion index, which reflects the portion of the index's components that are moving in a pattern consistent with the overall index. Now, we don't need to get into details here, but it is possible that of these 10 indices, 9 are indicating that the economy will improve and 1 is indicating that the economy will turn south or turn downwards. The diffusion index tries to capture this sort of information, telling us roughly what the different indicators are saying and whether they are pointing in the same direction or whether they are pointing in different directions. Obviously, if we have 5 indicators pointing up and 5 pointing down, then we cannot draw any clear conclusions about the direction of the economy. On this slide, we look at coincident indicators and lagging indicators. And again, all these come from Exhibit 7 in the curriculum. And in this exhibit, you will find the reasons for why we are calling these coincident indicators and why we are calling these lagging indicators. I'll just highlight a few over here. Inventory to sales ratio is an important ratio, and I think there is a reasonable chance that you will see this on the exam. We saw this in an earlier section and it is coming up again. As we've discussed, inventories accumulate as sales initially decline, and then once a business adjusts its ordering, then inventories adjust again. I'll just make a simplistic point here that once a business downturn starts, after that the inventory numbers start to increase because inventory level builds up as production initially stays roughly the same and the sales numbers come down. So this number goes up or peaks after the business cycle has peaked. Therefore, this is a lagging indicator. Change in unit labor cost is also a lagging indicator. Remember, this is a measure of the labor cost associated with each item. So if this is the total cost of an item and this part is the labor cost, then we are saying here that roughly 20% of the overall cost here is labor cost. Businesses are slow at laying off people, and that is why a change in labor cost is a lagging indicator. Commercial and industrial loans outstanding. This is slightly tricky, but remember this is also a lagging indicator. Generally, these loans are used to build inventory, and therefore this is a lagging indicator for roughly the same reasons that we discussed over here. Coming back now to the 3 categories of indicators. We said we have leading indicators, then we have coincident and lagging. Clearly, leading indicators are useful because they tell us about the direction of the economy. So you might wonder, what is the benefit of coincident and lagging indicators? Coincident and lagging indicators can help confirm what leading indicators are telling us. So if we have a leading indicator at this stage which is telling us that the economy is going to peak or going to slow down, then after that we notice a coincident indicator peaking, and then we notice that a lagging indicator is peaking over here, then these two indicators, the coincident and lagging indicators, serve as a confirmation of what the leading indicator suggested earlier. But at times, if the coincident and lagging indicators are not confirming what the leading indicators are telling us, then we cannot be sure about what conclusion to draw from the leading indicators. As a general point, trade associations and public agencies also provide aggregate cyclical measures. For example, the Association of Purchasing Managers might share information related to the aggregate purchases and the prices of overall purchases made by companies. I don't think you need to go into the details, but this material is covered briefly in section 5.2. Take a look at examples 17 and 18. Example 19 is particularly important because it gives you several MCQ questions. Let us now summarize what we have learnt in this reading. The first point was related to the business cycle and its phases. If we have time on the x-axis and economic activity on the y-axis, then we can say that there is an overall trend related to the business cycle. In this example, the overall trend is upwards. The actual GDP or the real GDP, the real output will cycle around that particular trend. Over here, we will have an expansionary gap where the real output is more than the potential GDP. Here we have a recessionary gap where the real GDP or the real output is less than potential. You need to recognize the various phases. This is a peak, this is a trough. Over here we have an early recovery, a late recovery. This would be a slowdown. You need to know the definition that we talked about at the start of this reading and the 4 points that I made with regards to the definition. You need to understand how inventory levels, labor and capital utilization change across the business cycle. Next, we talked about the various theories that try to explain the business cycle. These theories also suggest what the government should or should not do in order to minimize the impact of the cycles. Simplistically, the classical theories and the RBC theories suggest that the government should not do anything. The cycles will take care of themselves. If an economy is in a recession, it will come out itself. The Keynesians take a very different view. The Keynesian view is that if an economy is in a recession, it will not automatically come out of the recession easily. The government needs to intervene. The government needs to have expansionary fiscal policy and the appropriate monetary policy to get an economy out of the recession. Monetarists, as the name implies, focus on monetary policy, and they insist that the money supply should be increased at a steady, predictable rate, which is in line with the overall growth in potential GDP. You need to understand the different types of unemployment and measures of unemployment. All the definitions that we talked about were important. Particularly important is the definition of the unemployment rate, which is the number of people unemployed divided by the labor force. Price levels and inflation. Here we talked about several items related to inflation. One point is that inflation is pro-cyclical. In other words, inflation moves with the business cycle. We talked about the different causes of inflation, the two major ones being cost push and demand pull. Cost push happens when there is an increase in an important cost component such as wages. Increase in wages shift the short run aggregate supply to the left, and that causes price levels to go up. Demand pull inflation is caused by a rightward shift in the aggregate demand curve, which again pulls prices up. We talked about three categories of economic indicators: leading, lagging, and coincident indicators. You need to go through Exhibit 7 and read through the various indicators that are given in the curriculum and understand why they are leading or why they are lagging or why they are coincident. As always, go over the summary, do the learning objectives, read them and make sure you can say something sensible about each of the learning objectives. I have asked you to do the examples. Some examples are essentially reading material. None of them are very long. If you have time, do those examples, but the examples where you have MCQ questions must be done. This is a very long course, the economics course I mean, and it will be very difficult to remember every detail. But at the very least, you need to be on top of the material that is tested in the examples and the material that is tested in the practice problems. These are a good indication of what you might see on the actual exam. If you have time, then also practice questions from other sources. That is it.